Order blocks are a key component in spotting trading setups and are heavily favored by smart money professionals. Yet, many traders find it challenging to recognize valid and reliable order blocks, which can jeopardize their positions. Engaging in trades without the skill to spot high-quality order blocks can be quite dangerous and may lead to notable losses. In this advanced guide, we'll dive deep into the complexities of order blocks, breaking down the classifications and offering step-by-step instructions to identify the ones with high potential. We'll go through the specific rules and conditions that help you detect high-probability order blocks directly on live price charts, and we'll walk you through entry and exit strategies that are built around order blocks in the market. So, traders, if that's the kind of content you're looking for, make sure to hit the like button to show your support, and don't forget to subscribe to the channel if you're new here. Welcome back, traders. Let's dive into the primary categories of order blocks. The first type we'll cover is the standard order block. In a bearish market context, this type points to the zone aligned with the final bullish candle right before a sharp and notable decline in price. The reasoning behind using these zones as potential reversal levels stems from the idea that they act as manipulation zones, usually formed right before a major market drop. Traders interpret these areas as points where a significant volume of buy or sell positions was likely placed. By incorporating these zones into our strategy, we aim to capitalize on the higher probability of a price reversal or directional change when price returns to these levels. In the example shown, we notice that after the final bullish candle appeared, the market dropped aggressively, creating an area of imbalance. Eventually, price moved back up, retracing to reclaim the liquidity gaps left open by the sell-off. As a result, the relevant order block was mitigated, signaling that institutional players likely filled their outstanding buy orders. Afterward, the price turned again and resumed its move to the downside. The second category of order block is referred to as the primary impulse order block. This particular type emerges when the price action fails to produce a strong or meaningful move after shifting its primary trend. In a bearish setup, the primary impulse order block is spotted as the initial weak bearish candle that appears right before a significant price drop. It marks a level where the market lacked the strength to maintain its previous bullish direction, potentially hinting at a trend shift or shift in sentiment. Let's examine an example. In this chart, the market is in a downtrend, and the price makes a bearish break of structure, falling beneath the prior lower low and leaving behind an area of imbalance. To pinpoint the most recent order block created by price, we focus on the first weak bearish candle that formed before the major move down. This candle serves as the primary impulse order block, signifying a potential change in trend or a reversal signal. It stands out as a key level of interest, where price could bounce or reverse upon revisiting that area, offering a high probability trading setup. The third type is known as the wick-based order block. In a bearish scenario, this type appears when the shadow or wick of the final buying candle, or the initial weak bullish candle, exceeds half the total candle length. In this setup, only the wick is considered the valid order block, while the body of the candle is ignored. This method offers a more precise and compact zone, compared to using the full size of the candle as the area of interest. As illustrated here, the price drops sharply and forms a sequence of bearish breaks of structure, confirming the downtrend. It becomes evident that the candle at the furthest point is the first weak bearish candle that formed just before the strong downward momentum. But in this case, the wick of that candle is larger than half the entire candle. As discussed earlier, we mark the entire wick alone as our order block, rather than using the full candle range. So let's move on to the next type of order block, the engulfed order block. In a bearish setup, a bearish engulfed order block forms when the entire body of the final bullish candle is fully overtaken by the next candle. This signals a strong surge in selling pressure that completely dominates the preceding buying force, triggering a sharp move downward. In this example, we observe a shift in the market structure as price breaks below the support, indicating a change in character from the prior uptrend. The candle we're examining is the last bullish one before the price turned bearish. Its full body is engulfed by the bearish candle that follows, confirming aggressive bearish intent. On a closer look, you'll notice that the wick on this bullish candle is larger than half the size of the total candle. This raises the question, should we classify this as a wick-based order block, where only the wick is highlighted, or as an engulfed order block, using the entire candle as our zone? In this particular scenario, it's more accurate to treat it as an engulfed order block, considering the full candle body as the key area of interest rather than just the wick. Breaker block. Explained. A breaker block represents a previously valid order block that fails to reject price and instead gets broken through. Once breached, it transforms into a new supply or demand zone, depending on the direction of the breakout. Markets may ignore certain order blocks due to various factors, such as a change in market structure, price being overvalued or oversold, interaction with higher time frame key levels, proximity to resting liquidity zones just above or below the block. Checkmark. Key characteristics of a breaker block forms when a previously respected order block is invalidated, becomes a new zone of interest, supply or demand, after the breakout. Most effective when price breaks through it with strong momentum, leaving minimal pullback. Often accompanied by inefficiencies, imbalances, in price action that get filled later. Bar graph example scenario. In the illustrated case, price made a strong upward move, breaking through a prior order block with aggressive bullish candles. This move left behind a price imbalance, or inefficiency. Eventually, price retraced to fill that inefficiency, revisiting the zone. Upon reaching this new breaker block, price respected it and launched another bullish rally. Interestingly, the market ignored the original extreme order block, confirming that the breaker block had become the new key area of interest. Mid-movement pivot order block. The mid-movement pivot order block forms when a single candle of the opposite color appears within a strong bullish or bearish trend. This candle is significant because it often signals a potential reversal or a temporary pause in the ongoing market direction. Light bulb market psychology. These pivot candles suggest a moment of indecision or loss of momentum during an aggressive move. Traders interpret these zones as potential areas where price could stall or reverse. Therefore, such levels become key watch zones, as price often reacts to them when revisited. Pushpin. Key takeaways. Acts as a pivot point during strong price movements. Indicates exhaustion, consolidation, or reversal potential. Valuable for spotting reaction zones during retracements. Now that we've thoroughly covered the major types of order blocks that commonly appear on live charts, you should now have a clear framework for identifying and interpreting them in real time. Revolving light before you enter a trade. Backtesting is essential. Before applying any of these strategies or entry models to a live account, it's crucial to backtest them thoroughly, at least 100 times. This process allows you to understand how the strategy behaves in different market conditions, account for trader psychology, volatility, and session-based behavior, refine your risk management rules, gauge realistic win rates based on time frames and setups. Proper backtesting is the foundation of confident execution. With this preparation, we'll now move forward into the entry models based on order block analysis. Entry types in order block trading. There are 4 main types of trade entries that can be utilized when executing trades based on order blocks. The choice of entry type depends on several key market factors, including market structure and movement, session timing, e.g., London, New York, Asia, volatility levels, overall market conditions. By carefully analyzing these variables, traders can select the most optimal entry approach to increase the effectiveness of their trades and improve risk-to-reward ratios. 4 primary order block entry types. When executing trades using order blocks, there are 4 core entry methods. Each method carries its own risk-reward characteristics and should be selected based on current market conditions, volatility, session timing, and trader preference. 1. Wick entry. This method involves placing your buy or sell order directly at the wick of a valid order block. Sell scenario. The stop loss is placed a spread size above the highest wick of the order block. This setup offers a wider stop loss, which may reduce the reward to risk ratio. However, it significantly increases the likelihood of order execution, as price often taps the wick before reversing in the expected direction. 2. Body entry. In this approach, the entry is based on the body of the order block candle. Sell scenario. Stop loss is still placed a spread size above the highest wick of the block. This method offers a tighter stop loss compared to the wick entry, potentially improving the reward to risk ratio. However, the tighter entry increases the risk of missing the trade, as price may only tap the wick without reaching the candle body. 3. Midpoint entry, preferred. This entry involves placing the order at the midpoint of the entire order block zone. Sell scenario. Stop loss is set a spread size above the highest point of the order block. This refined entry technique results in a smaller stop loss, leading to a much higher reward-to-risk ratio, often double compared to other entries. Due to its balance of precision and risk management, this entry type is highly favored in professional trading plans. 4. Aggressive body entry. This method places the entry at the body of the order block but positions the stop loss within the block zone, just touching the highest wick. This approach offers the tightest stop loss but carries increased risk, as any deep mitigation of the block may trigger the stop loss before reversal. Identifying high-quality order blocks. 4 essential rules. To consistently identify order blocks with a high probability of success, traders must adhere to 4 key rules. These rules help filter out weak or unreliable zones and improve overall trade accuracy and consistency. Rule 1. Presence of market inefficiency. A high-quality order block must leave behind a clear inefficiency, an imbalance between buying and selling activity. Inefficiency typically appears as a gap between candles, indicating a rapid price move where the market failed to fully trade both sides, buyers and sellers. Efficient moves are marked by smooth, overlapping candles without gaps. Inefficient moves, in contrast, feature gaps or imbalanced price action, which often get revisited for price correction. Right arrow. A valid order block should leave behind such inefficiencies to suggest potential for price mitigation. Rule 2. Break of structure, BOSS, or change of character, CHOCH. A high-quality order block must lead to either a break of structure or a change of character in the market. A break of structure signals continuation of the prevailing trend. A change of character signals a potential reversal or shift in market direction. Right arrow. The order block becomes more reliable if it contributes to or follows these significant structural changes. Rule 3. Liquidity sweep before reaching the order block. Before price interacts with the order block, there must be a sweep of liquidity, where price grabs stop losses or pending orders resting above or below key levels. Liquidity zones are areas where clusters of stop losses or limit orders are likely placed, e.g., highs, lows, equal highs, lows, etc. These zones act as magnets for price because they contain large amounts of resting liquidity. Right arrow. When price sweeps liquidity before reaching the order block, it enhances the likelihood of that block acting as a strong reversal zone. Why this matters? The role of liquidity. The market thrives on liquidity, it fuels momentum. If price hasn't captured liquidity before reaching the order block, the block itself may be used as a liquidity source, increasing the risk of it being invalidated. By ensuring liquidity is swept prior to mitigation, we align with how smart money operates, increasing our edge. In essence, these rules guide traders in filtering for the most probable and effective order blocks, improving decision-making and trade outcomes. Ignoring any of these elements can result in unreliable setups or unexpected invalidations. Liquidity dynamics and order block validation. A practical example. In this example, we observe 2 consecutive bullish breaks of structure, BOSS, to the upside, resulting in the formation of 2 distinct bullish order blocks. Initially, price reacted slightly to the upper order block, but soon after, it began a downward move that swept the liquidity resting below the order block, as well as the equal lows formed near that level. Warning. Why didn't the price reverse from the upper order block? Because there was no liquidity sweep before price tapped into that zone. Without liquidity being collected beforehand, the market treated the upper order block as a liquidity pool rather than a reaction point, effectively using it to fuel a deeper move downward. Checkmark. In contrast, the reversal from the extreme, lower, order block was high probability. Here's why. Before reaching this zone, price swept the liquidity under both the upper order block and the equal lows. This liquidity grab allowed price to gain momentum, essentially refueling the move. Upon reaching the extreme order block, price reacted instantly and reversed strongly, pushing upward and eventually sweeping buy-side liquidity at the top. Key insight. The extreme order block offered a higher probability setup because the pre-ob liquidity sweep aligned with smart money principles, validating it as a strong entry zone for reversal or continuation trades. Rule number 4. The order block must be unmitigated. An essential rule in trading with order blocks is that they are one-time use zones. This means we focus only on the first interaction when price enters an order block. Once an order block has been mitigated, i.e., price has traded through it, closed beyond its boundaries, and the inefficiency has been filled, it loses its edge as a high probability zone. Retesting such a mitigated order block may no longer offer the same quality trading opportunity as the initial touch. Brain key takeaway. We trade order blocks only when they are fresh. Once price resolves the imbalance within them, we shift our focus to new zones of interest. Books recap and what's next. That wraps up this episode, traders. We've fully broken down the core components of trading with order blocks, how to identify valid order blocks, what makes an order block high quality, and how to execute trades using 4 powerful entry types. Rocket in upcoming episodes, we'll take it to the next level, diving deep into advanced entry models and order block trading strategies that you can plug directly into your trading plan. Thank you for watching.